Welcome to the next edition of Pizz-Spectives. My name is Rob Pizzichetta, founder of Mont Wealth, and today we're going to go into a little bit more detail of what private credit is, and we're talking to one of the portfolio managers of Alceon, Omar Khan. Welcome, Omar.
Thanks, Rob. Good to be here.
Great to have you. Obviously, very topical at the moment. There's been an ASIC white paper out, so we'll get into that a bit later. But tell us a little bit more about Alceon, who you are, and who you're trying to support in the market.
Yeah, thanks, Rob. So I think probably the best way to describe Alceon is a private multi-strategy alternative investment manager or a trusted capital partner. We invest across real estate, up and down the capital stack, which includes private credit, private equity, structured credit, as well as special situations across listed and private markets. But really, by and large, we're a team or a business largely with an institutional approach to mid-market. We like the mid-market, and we focus only on Australia and New Zealand.
Okay, so what's the mid-market? Explain that.
Yeah, so mid-market, and given we're talking about private credit and real estate private credit, so maybe let's use that lens. We're really talking about loans in that $20 to $100 million zone. Mid-market development. We're not talking about ASX listed large developers or real estate owners. And we generally stay out of the small real estate owners and developers, that sub $20 million market.
Okay. So you're not doing like a free unit townhouse development. You're doing a little bit more larger size construction.
Yeah, that's right. If you think about if we're funding something, our average loan size is probably somewhere to 30 to 40 million. So naturally, the development sizes are sort of 70 million plus.
Okay.
So quite material.
And in the just construction, what other parts of residential deal into?
Yeah, so I guess perhaps there's a link into that. Our focus in real estate lending is primarily to real estate developers. So that's acquisition of land, funding the post-development. So that's whether that might be land subdivisions, might be houses and townhouses, but we're not, to your point, financing the end consumer, where we're financing large developments of houses and townhouses, low rise, which is in up to 8 stories, or high rise. Look, we generally don't do that much high rise to date. In any case, we felt that you don't get paid enough for that risk, but we're pretty active in the rest of, I guess, that residential real estate landscape. But outside of that, we're pretty open to financing industrial, commercial, retail. On the debt side, we're speaking here. Mm-hmm. As long as the risk and return makes sense to us. Okay. We're not, it's just that we believe that the risk return nexus is quite attractive in residential, and that's why we're active in those markets.
Understood. Now, I would ask the question, why don't these construction companies just go straight to a bank to get loans? Like, why do they come to you? What services are you trying to offer them?
Yeah, so I think there's a strategic and a regulatory element to this, which is that a mid-sized asset owner, developer, or builder, or constructor, or borrower ultimately find it very difficult to access debt capital from a traditional bank. These banks are primarily focusing on the mum and dad home mortgage lending part of the market and institutional, that mid-sized market. And this is not just against real estate lending, but all forms of lending. A lot of mid-sized businesses have turned their mind or have approached private credit businesses like us because the capital is faster, more flexible, and helps them better achieve whatever their business or development outcomes might be, and generally in a much faster time frame.
And are these clients or customers of yours, are they one-off? Are they repeat? Who are they?
So for Alceon, we're a big believer in relationships across our business. So the vast majority of our borrowers or sponsors tend to be repeat businesses. And we quite like that because we learn about your business practices, about your approach in that due diligence phase, but also in that execution phase. And so we naturally want to transact with you again and again. And so in the vast majority of instances, we have multiple facilities with the same lender, which we really like, and it's a relationship that grows over multi years.
And so let's talk a little bit about that loan origination. So when you get that new customer and you set up and you structure the loan, how does that all work? And how do you protect the underlying investor, which is us?
Yeah, loans come to us in a variety of ways. One, proprietary relationships. We've been in the market, and executives at Alceon have been in the market for so long that we have some really deep relationships across the East Coast, South Australia, WA, of course, and New Zealand as well. But outside of that, it might be lawyers, it might be accountants, or it might be a financial advisor or a consultant, or a mortgage broker. All of those channels, they come to us. We generally prefer not to participate in competitive processes because in many instances, they might be just driven just by the headline rate, whereas we believe that we have more to offer a borrower than just the headline rate. Generally, at Alceon, the vast majority of our team are real estate professionals, equity professionals. So we come to debt with an equity lens. And so we believe we can provide it. And certainly, I think our borrowers and sponsors like that. We can bring more to the table than just purely debt. And that value add is quite important to us. So that's, I guess, the origination process. And I think the second part of your question was around security. Now, security obviously has multiple dimensions, but the core is that in the Alceon Debt Income Fund, every single underlying position must have real estate security in Australia and New Zealand. The maximum net leverage is 65%. And in all instances, it must be senior or first registered mortgage. So that's your primary security. Then in addition to that, there might be other security, which might be through directors' guarantees or personal guarantees or company charges. And then there's also conditions in the contract or in the facility agreement, which might relate to pre-sale cover. So what percentage of sales have occurred prior to us advancing that money, post that, the rates of sales, or other conditions we need to meet for them to meet along the way. And along that entire period, our team is very actively involved every month with the sponsor, ensuring that project is going according to the plan that we all agreed. And of course, more importantly, is in compliance with that facility agreement. And what I was saying earlier, that real estate expertise becomes really important in that phase because everyone on the team has had real estate development or asset management or acquisition experience. We bring that to bear in understanding risks because we don't want to know the risks after they've occurred. We position ourselves so we can see them coming ahead of us. And should something occur, that we're able to work with the sponsor to manage that risk.
Okay. So let's talk about that management then, because inevitably, when it comes to lending, there's eventually going to be a problem somewhere. You'll go into a deal in good faith, but nonetheless, there's going to be an event. Now, we often see headlines of defaults. Default doesn't necessarily mean a loss. So how do you then manage that default and then to ensure that you're protecting the capital?
Yeah, that's a really good question, Rob, because obviously there's been lots of media noise around defaults, etc. So ultimately, it really all starts with what I was just talking about before, which is being actively involved in that loan, in the management of that, and the execution of that program to ensure that you can see issues well before they arise. But from time to time, issues do arise. And when we speak to our investors, as we have, you and I have spoken, is that defaults occur. It's a natural part of lending for defaults to occur. And really what that means is they're in breach of a key term of the agreement and they haven't been able to cure that breach. And we work with them to try and help them cure that breach, whatever that might be time related, might be related, might be sales related. Then there's obviously a variety of elements where that breach might be related to. We help them try and cure that. And where that doesn't occur, so we obviously have the right to place that facility in a default, at which point there may also be a default interest or an additional interest charge to the borrower. But at this point, that doesn't mean that we're not going to collect 100% of the capital and 100% of the interest, plus in some instances where there's a default interest applicable, collect that. So it is entirely possible that, and often is the case, that when a facility goes into default, the net return to investors is often higher because we're able to manage that default process and ensure recovery of 100% of the capital and interest. And this is where a default goes into impairment, where we might believe that 100% of the capital and interest can't be recouped. That's probably that next phase of default, which people obviously get confused with. But I think certainly with us, there hasn't been an instance where we've lost investor capital across that entire portfolio. So that goes to that active management in that free and enduring phase.
Yeah, understood. All right. Here we are in the current environment, economic environment. Things are feeling like they're starting to slow, momentum slowing, rates are coming down, which is probably a positive. How are you positioning the portfolio now for the next 12, 18, 24 months?
So I think where we're now, and there's probably there's been a significant increase in the supply of capital to this sector or the asset class. And what our observations are, that's obviously doesn't tighten rates, but also perhaps a repricing of risk. So really what that means for Alceon is we don't want to go chase return the risk curve or compete in processes and I guess dilute the return to our investors. There's a natural compression that has occurred, which is probably 50 to 100 basis points in terms of that lending rate. But outside of that, we're pretty happy for our loan portfolio to shrink in this period if that occurs, so that we're not chasing risk up the curve or competing down returns. There's still good opportunities in the market where we want to participate in, but we're certainly not changing the way we assess risk or approach lending.
Yeah, well, that's good to hear as an investor. That's good to understand. And also your portfolio has actually shrunk, right? Your original size was much larger than it is today. How are you playing that?
Yeah, from memory, I think our loan portfolio was circa 3 billion and it's come back to about 2.6 billion. That's all real estate loans in Australia and New Zealand. And that's exactly the point is in some of our closed-end vehicles, there's been a return of capital. And yeah, as a firm, we're very comfortable with that. We don't want to be in the market chasing deals, and certainly philosophically for Alceon, we don't chase FUM growth. We don't chase growth for growth's sake. We want to place our capital in transactions where we believe there's a good risk-adjusted return for us. At Alceon, as staff, we're heavily co-invested alongside our investors and aligned with our investors. So we see them as our partners, and we want to make sure that we're staying true to that philosophical view.
Fantastic. Now, obviously, there's been plenty of press around more recently around private credit. Every second day, there's an article in the AFR, which is actually good. It's actually bringing a spotlight to the industry. We want to protect the consumer. We want to do the right thing. There's been an ASIC white paper, and we've heard Joseph Wongo, the chairman of ASIC, talk a little bit about the lack of transparency, wanting more data. Now, without putting you on the spot, how do you view what ASIC is trying to achieve here? Do you think it's a positive, negative, and why?
Yeah, maybe if I just, before I respond to your question, preface that we obviously, and you know this too well, right? Private assets have been here for a long time. This isn't a new revolution. Private capital has been here for a long time. Certainly, the size and allocation of private capital has increased. And private credit is a much more significant market outside of Australia. In Australia, given the dominance of the four big banks, it has been less relevant. But since 2016, since those regulatory changes I referred to earlier, there had been a significant growth of this market. I think our general view is transparency is a good thing. Hopefully we try to be as transparent as we can with our investors in terms of the portfolio and the underlying assets. I think standardization of what senior means or what a default means, I think you touched on default earlier, I think that can only be a good thing. Now, whether that's through ASIC regulation or industry consensus, I'm not really sure I don't know if we've thought that through fully, but I think more transparency and standardization can only be a good thing if that leads to confidence for investors, for your clients, if they feel more confident about the asset class.
100%. And do you know off the top of your head what percentage Australia has of private lending versus, say, US or UK?
Yeah, from memory, globally, in Europe and the US, the benchmarks might be 30 to 40, if not higher. Whereas in Australia, it might be in the low end of the teens.
Yeah, okay.
So we have a long way to go. Now, it might be our market's different, and we might not get to 30s and 40s, but certainly private lending is healthy because we're providing efficient capital to mid-size businesses and real estate developments, which is creating growth, value, jobs, but we're also allowing investors to participate in that. We certainly think that's economically is quite a positive story.
What a great point to finish on, Omar. Now, just before we do conclude, any discussion we've had today is general advice only. Anyone acting on this advice does entirely at their own risk. Please go and seek financial advice. So now, Omar, if people want to learn a little bit more about Alceon, where do they find out some information?
Yeah, look at our website, alceon.com.au, but most importantly, probably they should be talking to you, Rob.
I probably should. You're right, Omar. Thank you so much for your time, mate. Appreciate it.
Thanks. Cheers.